Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Carrier Global CORP quarterly report. Carrier Global Corporation offers a diverse range of businesses and services across two main segments: heating, ventilating and air conditioning, HVAC, and refrigeration. Key products and services include HVAC, plus air conditioners plus heating systems, plus heat pumps plus building automation systems, plus aftermarket components plus repair and maintenance services, plus rentals, plus modernization and upgrades refrigeration, plus transport refrigeration products plus monitoring solutions for trucks, trailers, shipping containers, and intermodal applications. The company operates under various brands including Carrier, Viessmann, Toshiba, Automated Logic, Bryant, CIAT, Day and Night, Heil, NORESCO, Riello, Carrier Transicold, and Sensitech. Carrier Global Corp's stock price drop. A year of challenges in the past year. Carrier Global Corp's CARR stock price has plummeted by over 19.42%, influenced by several key news and financial events. The decline can be attributed to a combination of factors, including weak earnings reports, lowered guidance, and concerns over market demand. The company's third-quarter results in October 2024 fell short of analysts' expectations, leading to a significant stock drop. This was followed by mixed fourth-quarter earnings in February 2025, which saw adjusted earnings surpass expectations, but net sales missed the forecasted figures. In July 2025, Carrier's second-quarter earnings release led to a further decline in stock price due to unchanged guidance and concerns over weaker residential markets in the U.S. and China. The market also reacted negatively to slowing European demand and potential issues with the Viessmann heat pump business acquired by the company. The final blow came in October 2025, when Carrier reported a 7% decrease in net sales and a 4% organic sales decline compared to the prior year for Q3 2025. The weak residential end markets and distributor destocking in the Americas weighed heavily on the stock, contributing to its overall decline of over 19.42%. The primary drivers of revenue growth or decline can be summarized as follows. Revenue decline is primarily driven by a 9% decrease in product sales, with notable declines in Climate Solutions Americas, minus 12.6%, and Europe, minus 0.6%. Service sales also declined by 1%, except for a $26 million increase in Climate Solutions Americas. On the other hand, revenue growth is driven by a 4% increase in product sales in Climate Solutions Europe, offset by a minus 1% decline in Asia Pacific, Middle East, and Africa. Service sales growth was seen in both Americas and Europe, with increases of $26 million and $18 million respectively. Segment-specific drivers reveal that Climate Solutions Americas experienced a mixed performance, with commercial business up 28%, but volume reductions in residential minus 30% and light commercial minus 4% businesses. In contrast, Climate Solutions Europe saw volume reductions across all its businesses. Net income and profit margins experienced significant fluctuations between 2024 and 2025. For the 3 months ended September 30, 2025, net income decreased by $26 million, minus 5%, from $481 million to $455 million, while operating profit margin dropped from 12.8% to 9.7%. However, for the 9 months ended September 30, 2025, net income plummeted by $1,614 million, minus 51%, but operating profit margin increased from 11.1% to 12.2%. The year-over-year comparison revealed a decrease in net income of $19 million, minus 4%, and a decline in gross margin of 14%. The reasons behind these changes are multifaceted. The acquisition of Viessmann Climate Solutions, VCS business on January 2, 2024, likely had an impact on net income and profit margins. Additionally, lower volumes, inventory step-up costs, backlog amortization, and unfavorable impacts from acquired assets contributed to the decline. On a positive note, interest expense decreased by 11% due to debt repayment, while the effective tax rate dropped from 22.3% to minus 0.2%, resulting in a net tax benefit. These factors suggest that the company is making efforts to reduce its expenses and optimize its financial performance. The company is indeed generating positive operating cash flow. This is evident from the financial summary and specific points provided. On page 13, it is stated that net cash flows provided by continuing operating activities reached $1,400 $473 million in 2025. Additionally, on page 56, the company's continuing operating activities totaled $1,076 million in 2025. Furthermore, page 55 explicitly states that the company generates positive operating cash flow. These figures and statements collectively confirm a strong financial performance in terms of operating cash flow. The company's debt level and interest expenses have undergone significant changes. Initially, the total debt increased slightly from $23,008 million to $23,238 million. However, a later report reveals a decrease in total debt by $446 million, bringing it down to $11,916 million. Regarding interest expenses, there is conflicting information across different pages. Some reports indicate a decrease of $15 million, $116 million in 2025 versus $131 million in 2024, while others show an 11% reduction from $127 million, 2024, to $116 million, 2025. Another report suggests a more substantial decrease of 26%, with interest expense dropping to $343 million in 2025, compared to $462 million in 2024. Unfortunately, the exact impact on long-term notes is unclear due to unspecified increases in interest payments. The company's financial performance varied across different segments and regions. In the United States, sales declined by 3.5% compared to 2024, marking a poor performance. Internationally, Europe experienced a significant downturn of 9.6% in the first 3 months, and 13.2% in the first 9 months of the year. However, Asia-Pacific showed mixed results with an increase of 4.1% in the first quarter, but a decline of 0.5% in the first 9 months. On a more positive note, the other region performed well, with sales rising by 7.6% in the first 3 months and 0.6% in the first 9 months. Within specific segments, Climate Solutions Europe stood out for its good performance, while the Fire and Security segment struggled due to poor results, leading to its divestment. Management is optimistic about the company's future prospects, driven by its international growth strategy, which accounts for 27-31% of net sales. To create long-term value, the company will invest strategically in profitable growth opportunities, capitalizing on favorable secular trends such as urbanization and energy efficiency. The company has also made progress in reducing debt and increasing transparency through revised reportable segments, with a stable outlook from Standards & Poor's Global Inc. and a positive outlook from Moody's Investors Service Inc. Management is confident that the company's available cash and operating cash flows will meet future needs, enabling continued growth and expansion. Acquisitions and divestitures overview. United Technologies Corporation, UTC, has made significant acquisitions and divestitures over the years. Notable acquisitions include Kid Fire Fighting, Inc., KFI in 2005, and its reacquisition in 2020. In 2024, UTC acquired Viessmann Climate Solutions business. On the other hand, UTC has also undergone several divestitures. These include the disentanglement of Chubb Australia's business, which is expected to be completed by late 2026. Additionally, KFI divested its AFFF businesses in 2013, and UTC sold its commercial and residential fire, access solutions, and industrial fire businesses, as well as its commercial refrigeration business. The company has also undergone a portfolio transformation through various transactions. The company has demonstrated a commitment to returning value to its shareholders through 2 key initiatives. Firstly, it has paid dividends, with a total payout of $583 million over the 9-month period ending September 30, 2025. Secondly, the company has also engaged in share buybacks, repurchasing 36.3 million shares for an aggregate price of $2.4 billion during the same period. There are concerns about inventory buildup, with evidence of increasing raw materials, work in process, and finished goods. However, there is no clear indication that this will lead to supply chain disruption, although delays and disruptions in delivery have been noted. That concludes the financial summary for Carrier Global CORP. Feel free to comment below, and I will be happy to answer them when possible.